was new. The problem wasn't in what he said, it's in how he said it. So policymakers and economists will look at this and say, well, he said something pretty obvious. Market participants look at it very differently. They'll say he said something that's worrisome for the fixed income market. It's worrisome for what I've been betting on for a very long time, which is ample and predictable provision of central bank liquidity, and therefore it's worrisome for stocks. So I think this is simply, Wilfred, the economist and policymaker not understanding that their words are interpreted very differently in the marketplace.
It's a weird situation, Mohamed, because you've got Treasury yields rising, which in effect, it should be a good thing, right? We've been expecting higher growth. We've been wanting higher growth. We needed to get out of the depths of the pandemic and more jobs and more stimulus to help fight it. And so if Treasury yields are rising for the right reasons, and that's why stocks have been rising, why does it feel so ugly? And why does it feel like the market is pressing the Fed to do more when Powell sits there and says, we're going to do as much as we can and we're going to stay all in until we totally get through this?
So this is really important. It is a good thing that Treasury yields are going up for the right reason. And the right reason is that this economy is set to recover very strongly. And that's good for the stock market long term. The problem are the initial conditions. It's what you've heard me say for a long time, the massive disconnect between fundamentals and what have been liquidity-driven valuations. I was very struck by the words that Mike and Stephanie said. I agree with them when they referred to, oh, it is those who have high story to substance that are getting hit. It is those where the sentiment was the driver. It is those where liquidity was the driver. All that tells you is that we've had a massive disconnect. And what we are adjusting to is the fact that we cannot assume QE infinity. We cannot assume that interest rates will remain low forever. And that means that two things that have worked so well for stocks are under pressure. Tina, there was no alternative. Well, guess what? There is an alternative now. And then secondly, importantly, is what all the model-driven flows are, which is stocks, because when discounted cash flows are what they are at very low interest rates, of course you buy stocks. And that's what's being challenged.
Shepard Smith here. Thanks for watching CNBC on YouTube.